Monte Carlo simulations play a crucial role in financial market predictions by modeling uncertainty and evaluating potential investment outcomes. By running thousands of simulations, analysts can assess risks, forecast market trends, and make data-driven financial decisions. Why use Monte Carlo for financial market predictions? Financial markets are highly volatile, influenced by factors like interest rates, geopolitical events, and economic conditions. Monte Carlo simulations help by modeling stock price movements based on historical volatility, estimating portfolio performance under different market scenarios, assessing risks in asset pricing and investment strategies. Case study: stock price forecasting. Imagine an investor analyzing a stock's future price using Monte Carlo simulations. One historical data is used to estimate volatility and expected returns. 2,000 of potential price paths are simulated using a random process. 3. Probability distributions help forecast best and worst-case investment scenarios. Portfolio risk management. Monte Carlo methods are widely applied in portfolio optimization. Analysts use simulations to evaluate diversification strategies to minimize risk, model correlations between different assets, determine the probability of achieving target returns, derivatives pricing and risk assessment. Monte Carlo simulations are fundamental in pricing complex financial derivatives, including options pricing using stochastic models like Black-Scholes, value at risk (VR) calculations for risk management, hedging strategies to minimize exposure to market fluctuations. Challenges in financial Monte Carlo applications. Data accuracy requires high-quality historical data for reliable predictions. Computational intensity. Large-scale simulations demand significant processing power. Market unpredictability. External events can introduce unforeseen market disruptions. Conclusion: Monte Carlo simulations provide financial professionals with a powerful tool to model uncertainty, optimize portfolios, and assess risk. By leveraging probabilistic techniques, investors and analysts can make more informed decisions in an ever-changing financial landscape.